Okay, so let's talk about 5 different reasons as to why you should be investing right now. Starting with reason number 1, like all crises, this one will eventually pass. Let's be honest, the media do a fantastic job at presenting the doom and gloom headlines in the press. Inflation at multi-decade highs, a cost of living crisis, a stock market crash, a property market at major risk, and a global recession. That doesn't exactly make you think about the world of investing in a positive light. If anything, it puts people firmly on the defensive due to the high degree of perceived risk. And funnily enough, this is just another classic cycle of what the panicked investor does. They buy when things are rosy and sell at the first sniff of economic distress. Warren Buffett once said, if you can't control your emotions, then you cannot control your money. So in order to help control our emotions, sometimes it's worthwhile looking back in the past in order to ground our expectations. Because if we look back in history, we've had some real serious market crashes and the stock market has still gone on to recover. For context, a study put together by Yardeni Research showed that since 1928, we've had 22 bear markets in the past 95 years, meaning we see a bear market roughly every 4.3 years, the worst of those bear markets being the Wall Street crash in the 1930s, where the market declined 83%. And still the market managed to recover from there. And let's be frank, we might have high levels of inflation and lackluster economic growth forecasts for the rest of this year. However, we're certainly nowhere near 70% unemployment rates and mass-scale poverty like we saw back in the day. It's just not even close to being on the same scale. So I think it's certainly wise on occasion to step back away from the markets and certainly remind yourself that this too will pass and better days will come around. And with that mindset comes more optimism and opportunity, which leads me quite nicely onto reason number 2, which is markets can be a massive discounting mechanism. Right now, the S&P 500 trades at 16.7% below all-time highs. The FTSE 250 also trades 18.3% below its all-time highs too. That's like me saying to you guys, well, here's a discount voucher in order to go and invest in assets. I mean, we don't exactly give it a second thought when we see a 20% discount at some of our favourite retailers. So why would we be hesitant about investing in shares that will inevitably go up in value? Seems like a no-brainer, but let me explain it like this. If company X was a great buy at $100 per share, with growing revenue, stable profit, a strong balance sheet and a positive cash flow, but it now trades at $80 per share, surely that makes it a better investment trading at better value if all of those company fundamentals remain the same. That discount should make it so much more appealing to actually own shares within that company. What Bill Gates has just done with Microsoft stock is a great example of this. Microsoft stock is currently down 30% from all-time highs, from $342 per share to now trading at just $240 per share. And Bill Gates has just swooped in and collected 38,320,050 shares in the company which he co-founded, which is actually the equivalent market value to about $9 billion. Now, as of right now, Bill Gates is the 7th richest bloke on the planet, so he certainly knows a thing or two about making money. But it was actually the 6th richest bloke, Warren Buffett, who once said, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. And with Microsoft now trading at a forward P of about 24 times earnings and continuing to see growth in both revenue and profit, clearly Bill Gates now certainly feels like it's a good opportunity to buy more shares within a wonderful company because he believes there's going to be plenty amount of upside from today's current market price. And that's exactly what we should be focusing on with our own investments within our own investment portfolios, more now than ever before. Reason number 3, volatility doesn't equal more risk. When you first started out investing, you probably reflected on what your appetite for risk actually is. And you probably came to some kind of conclusion as to how exposed to financial market risk that you wanted to be. And that level of risk differs for different people in different financial circumstances. If you were approaching retirement, typically an investor would have a lower appetite for risk in order to reduce the volatility within their portfolios at the expense of potential further upside reward. But if you're just starting out investing, you've probably got a slightly higher appetite for risk, and as such you might be more comfortable with bigger portfolio fluctuations because you've certainly got plenty of time ahead of you for the stock market to recover. But with that, you also potentially get a higher rate of return too. It's the old-fashioned equation of risk versus reward. Now, when you went out to make your first investments, perhaps you created a standard 60-40 investment portfolio, you certainly accepted the risk at the time. And just because markets are declining now and volatility is significantly increased, it doesn't mean that you've actually acquired any more risk within that investment portfolio. Now, risk is defined as when you expose someone or something that's of value to danger, harm, or loss. And despite it might feeling like you've taken on more risk due to the unrealized values within your investment portfolio coming down, the truth is that you haven't. That 60-40 investment portfolio is the same right now as it was when you first started out investing. Your portfolio allocation remains the same, and therefore your risk level remains consistent too. And as such, there should be no reason whatsoever as to why you should be selling out of your investments. However, as a caveat, do let this be an opportunity for self-reflection. If your unrealized losses are keeping you awake at night, then it's probably time to reevaluate your appetite for risk moving forwards. Because whilst investing should certainly be a mechanism in order to generate wealth over time, it certainly shouldn't come at the expense of your wellness. Point number 4, you may look stupid, but only for now. Let me be honest, me, just like every investor out there, felt like an absolute investing genius at peak market values in December 2021. I personally had a portfolio largely split between tech stocks and an S&P 500 ETF. Tech stocks were on a rampage, the market was trading at all-time highs, and as a result, my unrealized profits were well into the 5-figure mark. Whereas now, with the markets crashing down in value, my investment portfolio, unrealized profits, now sits in the low 4 figures. And if you've done anything similar, then as of right now, you may look and feel quite stupid. Seeing a sea of red across your investment portfolio, perhaps somewhat confused as to how some of the largest companies on the planet today can have so much value just evaporate into thin air within such a short period of time. But it's not so much that that money has evaporated, it's just moved. With market cycles, money moves around into different industries and into different assets. Right now, and in the past 12 months or so, a substantial amount of money has actually moved into the energy sector. But with utilities, consumer staples, healthcare, industrials, financials, and materials all outperforming the S&P 500 last year, whilst the tech sector is actually close to the bottom of the list. Now, markets will always move in different directions depending on the macroeconomic conditions at the time, and because of that, individual stocks can certainly swing in value from any given year. So take a look at this chart of the S&P 500. If you continue to buy when market prices are low, and as the market falls in value, you'll only go on to benefit more when market prices recover, because the difference between future market prices and your average cost basis will be bigger, which means the higher your unrealized profits will be. So whilst the S&P 500 may have dropped 18.1% last year, and who knows, it may fall even more this year, actually what's more important is how it's performed over the past 10 years, gaining investors 167%. So you may look stupid for now, but discounts in the short term are great for the long-term investor. As Shelby Davis once said, you make most of your money in a bear market, you just don't realize it at the time. Point number 5 is nobody rings the bell at the bottom. Every day the stock market open bell rings, but nobody knows how the day will finish. That's due to the complete randomness and complete unpredictability of the stock market due to the infinite number of variables that are playing out in real time. Now, the longer the time horizon that you have, the slightly more easier, I guess you could say, or you certainly have a higher degree of certainty about the longer term performance of the stock market. We of course can't necessarily say what the stock market is going to do in the next month, next 6 months, perhaps even the next year, or perhaps even the next 2 years. But what we certainly can say with a higher degree of certainty is that over the next 5, 10 and 20 years, that our probability of success in the stock market will certainly increase, because we've got all of the studies and the data to back this up. A study that looked at market data of mid and large cap companies between 1972 and 2022 actually found that if you had invested for less than a year, you had between about a 35 to 48% chance of loss. However, if you take that investing time horizon up to 10 years, your probability of loss drops to 5%, and anything after investing for about 13 years, your probability of loss drops to 0%. In other words, a 100% probability that you'll go on to make money from investing into the stock market. All you had to do was simply stay invested for long enough. And that is the high degree of certainty that I like when I'm investing. So don't wait for someone to ring the imaginary bell at the bottom of the stock market. Instead, just keep investing, as the probability of your success will massively increase the longer that you stay invested for. So look, whilst now might not feel like a great time to buy into the stock market, history tells us that it is. But if you're still unsure, then be sure to click on this video next, where I'm going to share with you guys 9 different lessons that will absolutely change your financial life forever.